I think that's the most important thing to take away. So they've been doing it, with whatever means they have, a lot of it in the black market because of import duties and whatnot. But the more wealthy they become, 100%, they'll just continue to accumulate. To them, that is wealth. To a large portion of the world, gold and silver represent wealth. And I think people need to not look at it as an investment. You don't buy gold to become or silver to become wealthy. Now, silver offers that potential. I do believe that. I have a take on silver that, and say what you want about it, but I believe the military-industrial complex has been shorting silver for years. They need it in high-tech weaponry. They used to be quoted in the supply-demand numbers, and the military is gone. And I gave a speech at Vancouver Resource Investment Conference where I said there's 500 ounces of silver in a cruise missile. A guy comes up to me 3 years ago, and he says, I work for the Department of Defense. I almost fell over. And he says, I helped design the Tomahawk, and I know there's silver in it. I'll get back to you. You never hear from him again. I see him the next year, 2 years ago. He says, I'll be damned. There's between 13 and 15 kilos in a typical cruise missile, Tomahawk or Patriot. He says, you were right. And then I've gotten to know him, and it's in all sorts of high-tech aerospace and weaponry. And so who owns all the military contractors? Well, that's largely BlackRock. Who's the custodian of SLV? Well, that's BlackRock and JP Morgan and also GLD. And so what happens is they step on the price of silver. Don't believe me? There's 8 commercial banks that hold the largest concentrated short position of any commodity ever traded in the history of the COMEX market. Guess what it's in? Yeah, it's in silver. And then you see the trading 3.5 times annual global mine supply, 10 times the float in London on silver by commercial banks. They hold the paper price down. They build high-tech weapons. They take it out of the supply-demand numbers. Even though we're running structural deficits, they pull it out. But they need it to make the weapons to fund wars all around the world. Then places like the Ukraine get blown up. And who gets the reconstruction contracts? Oh, that's right. It's BlackRock. So when conspiracy and reality, sure, fine line, but why would 8 banks from the West have the largest concentrated short position in this stupid, archaic relic that no one needs, that being silver? Why would the silver price, when it's coming out of the ground at a 7-to-1 ratio, ask Keith Neumeyer, he'll tell you that, 7-to-1, meaning 7 ounces of gold for every 1 ounce of silver. It's now priced at roughly 100-to-1, coming out of the ground at 7-to-1. Why would these 8 Western banks hold these large concentrated short positions, which is as dumb as a mud wall in this environment? Why would they do that? Well, because the military-industrial complex needs it to make cheap weapons. And that's my belief, and I will take that to the grave with me. And the only way that gets beaten is by the rest of the world saying, aha, like China, we see what you're doing. You're suppressing the price to accumulate it for whatever the reason. But guess what? We're just as rich as you are. And we're going to do the same thing. In fact, we're going to pile on the short side with you, and we're going to stand for delivery. And at some point, the rubber will meet the road. And that is kind of, you could argue, a little microcosm of what you saw yesterday in the platinum market, where bang, up 7%. It's a short squeeze. So it doesn't mean it will continue, but that is a microcosm of what you will expect whenever you manipulate markets in this degree. They always end badly. Manipulations always end badly. You can only manipulate a market for an extended period of time by pushing it in the direction it's going. And forever, no one wanted these commodities and certainly wouldn't stand for delivery. They wanted our stocks, our bonds, our real estate, because we had trust. We don't have trust anymore. Now, as Zoltan Pozar says, we're moving to Bretton Woods 3, a system about transparency and commodities, a la blockchain and commodities. And they're going to rush to get the commodities. But instead of just throwing the kitchen sink at it, they have to do it slowly and methodically, or they cut off their nose to spite their face. Let it be volatile. Let it be volatile. Let it go up and then go way down, and everyone turns away and walks the other way, and then they stand for delivery and they keep buying and they let it go up and then they smash it and they stand for delivery. And this has been going on. It's accelerated. So yeah, I think we haven't seen anything yet. And silver is, to me, the most asymmetrical investment on the planet. Low downside, high upside. And if it were really set free, if you just took the 150-year price average of, call it 45-to-1, with gold at 33.15 divided by 45, right now, it should be minimum of 73 bucks. That's what 150 years worth of average price. You take that same 33.15 and divide it by 7, you're at 473. Now, if you told me silver was at 473 tomorrow, I'd say, oh, that kind of makes sense. That's a 7-to-1 ratio between its geologic footprint right now. It was 16-to-1, which was its geologic footprint for 5,000 years. I remember it being in the industry when the Dow Jones was 2,100 in 1989, and they said the first conference I went to, the guy said it's going to go to 10,000. They laughed him off the stage. Here you are at 40,000. So the point of it is that markets go higher than people think possible, and when you manipulate it, like interest rates were manipulated, they may go higher than people think. And asset prices may fall lower in the face of rising interest rates because of that manipulation. And the same thing is true here with silver and gold. You hold it back for that long in the face of massive global demand in an asset that is diminishing and depleting in nature. I did an interview with Rick Rule. He said 18%, just 18% of the silver that was mined last year or came to market last year came from primary silver miners. Right. The rest was byproduct and recycling. It's disappearing. So yeah, I think silver is definitely a play worth holding, but it's more speculative ultimately in terms of its performance.
You know, it's easy to scoff at gold and silver when they're not performing how you expect. But here's the thing. Gold and silver are not investments meant to outperform every quarter. They're stores of wealth, especially for large swaths of the world. For the elite in India, China, the Gulf, Southeast Asia, even parts of Africa and Latin America. Gold and silver means security, legacy, stability. They don't hustle for gains. They hold for permanence. So when you hear that these metals aren't investing in the traditional Western sense, you're missing the most important point. In many cultures, they aren't intended to be investments. They are the investment. Now let's shift to silver, because silver has a story that most investors still don't grasp. It's not just about price moves or supply-demand charts or macro narratives. It's a fundamentally structural asset entwined in industry, geopolitics, and yes, even military strategy. Let me tell you a story I've shared before. I was at the Vancouver Resource Investment Conference. Great energy, sharp people, and I raised my hand and said, I think the military-industrial complex has been quietly shorting silver for years. There were some nods in the room, but mostly skepticism. Then a gentleman approached me, worked for the Department of Defense, said he helped design the Tomahawk cruise missile. He told me there's about 13 to 15 kilos of silver in every one of those missiles, plus various systems on aircraft and rockets. That man, he never blinked. He vanished, returned later and confirmed everything I suspected. This is not abstract. This is real. Silver is a critical component in modern warfare. You want to know why 8 Western banks control the largest concentrated short positions on any commodity, even outpacing oil or copper? It's silver. These banks are acting not just as financial institutions, but as contractors to industry and military, controlling the supply via paper positions, while the metal is extracted underground and locked inside weaponry. That's not conspiracy. That's correlation backed by engineering testimony. You combine that with the global picture. China is buying every silver doré and concentrate from Peru. They pay above market prices, refine domestically, and quietly accumulate. India imports hundreds of millions of ounces. Eastern central banks quietly stockpile silver and gold, while Western banks stand tall, short paper, and act as custodians. The result? A global tug of war, with paper trying to suppress price and physical demand, relentlessly grinding higher. Let me break that down in real numbers. Only 18% of the world's silver supply comes from primary silver mining. The rest is byproduct or recycled, about 82% per Rick Rule's estimate. That means there's no hidden surge of new silver waiting to flood the market. It's a depleting resource with little elasticity. London's LBMA vault system reports about 800 million ounces of inventory, but half is encumbered by ETFs and allocations, leaving some 300 million that's actually tradable. Yet they report daily trade volumes of 3 billion ounces. That's 10x leverage and 3 times annual mine output, an explosive disparity that can't be sustained. So when we see massive paper shorts compressed by surging physical demand, we're not looking at garden variety speculation. We're looking at structural breakdown. As Kurt Winkleman once said, markets can be manipulated for a while, but only by bending them in the direction they're already moving. You cannot hold back a tide that's going out the door forever. Look at what happened with London's Bank of England recently. Suddenly, they extended gold settlement timelines from 1 day to 8 weeks and blamed it on truck shortages. Truck shortages, really? That wasn't trucks. That was liquidity shortages. That was a system under pressure. And whenever the system reaches that level of strain, public trust evaporates and prices explode when delivery catches up to demand. This is exactly why I say silver is the most asymmetric investment on the planet today. Low downside, virtually uncapped upside. Suppose silver reverts to its 150-year average gold-silver ratio of 45-1. With gold at $3,315 per ounce, silver should be near $73. Suppose it reverts to the fundamental ratio of 7-1, based on reserves. That puts silver at $473. Yes, you heard that right. And we're still at 100-1 today, which is a terrific discount for the smart investor.
Just in the month of May, Adam, we've seen a 700% spike in gold delivery from last year, same time, and which is May is usually a quiet month for gold. We've seen the largest delivery into the history of the COMEX market. Last I looked, it was over 16,000 contracts at 100 ounces apiece. People are institutions, whoever the heck it is, U.S. government, Treasury itself, I don't know. They're standing for delivery at a level nobody has ever witnessed before. 16,000 contracts, Adam, is $5.3 billion worth of gold.
Wow.
The largest delivery in the history of the COMEX market, not just in gold, but also in silver too. So there's a huge demand for physical holding of gold and silver. And you look at, the gold price that gets knocked down by $200, $100 for 2 days in a row nearly, and it shoots right back up. That's strength and resilience that I have never seen in 35 years. To me, the physical demand is overwhelming the paper price. And this is I was reading something on X the other day, a comment, if you will, between Vince Lancy and Luke Groman. And, Luke said, now imagine what happens if it was the U.S. government bringing back that gold. And the response to all the commercial banks, because they were basically saying that it almost looked like a sell-only market, that they were a coordinated fashion, that they got together with the managed money and said, this is about to blow up the whole market. There is no more buying allowed, only sell only. And that's what he was intimating. And he says, in response to the above from the U.S. government is FU, he says. Send us more gold next month, too, and more behind for July, August, and September. And Vince Lancy says, it was, Luke, it was. No ifs, ands, or buts. Bullion banks to cover the Treasury, calling it back, or the Department of Treasury itself, it most certainly was. Now, these are two of the smartest guys in the world. And basically what they're saying is that it's the U.S. government bringing all this gold back in. And if you look month over month over month over month, in fact, let me, if you don't mind, just share one thing with you.
Absolutely.
This is just the month over month increase since last year. If you can see that, COMEX gold delivery. This is not something that is just an outlier in 1 month. Month over month over month over month over month. And really, this goes back to November. Where we are, I would just simply say the biggest money in the world has been using any sign of weakness to stand for delivery and to accumulate more, and the price keeps going higher and higher and higher. And it's not just here. You look at what's happening even in China too, and the numbers are off the charts in China. I think they bought the amount of gold that they just bought was an 11-month high this last month. So yeah. I think the best of what we could expect to see in gold prices is still, and silver, is still way in front of us. I don't know it off the top of my head, but I would think it would be minuscule at best.
Like single digits? 10%?
Not even. I mean, maybe even the other way, probably the other way, if I had to guess. And net exporter would be my guess, because, the previous administration had no affinity to bringing gold into the COMEX, certainly. So it would have only been trader based. This is something different. And this really happened since November of 2024.
So as we continue unpacking this, I want you to step back and ask, why now? Why are we seeing the largest deliveries in the history of the COMEX gold and silver markets? Deliveries so large that they dwarf anything we've seen even in crisis periods, like 2008 or 2020. Why are these deliveries happening quietly, with almost zero mainstream financial media coverage? And more importantly, who is on the other side of this trade, standing for delivery while Wall Street yawns? I'll tell you, it's not the average retail investor, and it's certainly not your neighborhood hedge fund manager chasing yield in tech stocks. This is institutional. This is sovereign. This is structural. The US government, through the Treasury or even indirectly via related entities, may be calling back metal. That's the message that people like Luke Gromen and Vince Lanci are floating. And they're not lightweights. They don't speculate in conspiracy, they speculate in macro and capital flows. If they're even half right, and the United States is quietly repositioning gold as a core reserve asset, then folks, that's a tectonic shift in global finance. We're not talking about central banks just nibbling at bullion. We're talking about monetary rearmament. And that's the piece that people are still missing. There's a deeply entrenched belief in the West, particularly in the financialized world, that gold is an archaic relic. That belief is not just wrong, it's dangerous. Because while Western speculators are trying to figure out if Nvidia can go to $5 trillion, the East has already made its bet. And that bet is on gold and silver as the basis for trust in an unstable financial world. That's not theory. That's evidenced by over 20 consecutive months of gold purchases by the People's Bank of China. That's confirmed by India's relentless accumulation even in the face of rising prices and tariffs. That's supported by the BRICS' slow but deliberate development of gold and commodity-linked trade settlement mechanisms. Now, if this gold rush was purely speculative, we'd be seeing wild retail-fueled upside moves followed by volatility. But that's not what's happening. Instead, we see something more telling. Price suppression followed by resilient rebounds, massive COMEX deliveries met with increasing central bank reserves, and attempts to obfuscate rising physical demand with synthetic price action. In fact, the worse the price action looks on screen, the more metal is quietly flowing out the back door. That's not bearish, it's stealth accumulation. Take silver. We've talked about its asymmetric upside, but let's dive into that more because it's crucial. Silver is being consumed at a rate that defies its supply profile. Over 80% of annual silver production comes from byproduct mining, copper, lead, and zinc operations. Only 18% comes from dedicated silver mines. That means silver production isn't flexible. You can't just flip a switch and double supply. And in the meantime, demand is soaring from solar panels, electric vehicles, medical devices, and, yes, military-grade systems. Think about this. The US military won't even disclose how much silver it consumes. That's how strategically important it is. But we've had insiders estimate there are 13 to 15 kilograms of silver in every cruise missile. You're talking hundreds of ounces per weapon system, and those are being produced in volume. The military is a stealth buyer, and I believe they've been suppressing the price through the SLV and other custodial vehicles for years, using synthetic shorts managed through the very banks that fund the defense industry. BlackRock, JP Morgan, custodians of SLV and GLD, are not just asset managers. They are pillars of the financial military industrial complex. And when you have 8 of the largest commercial banks on record holding the biggest concentrated short position in any commodity in the history of the COMEX, and that commodity is silver, what does that tell you? It tells you that suppression isn't some fantasy. It's the business model. The West needs cheap silver to build its tech and wage its wars, so it keeps the price artificially low while accumulating through synthetic markets. But that game only works while the rest of the world plays along, and increasingly they aren't. China is buying raw silver concentrates from South America at well over market prices, refining it at home, and sidestepping the visible markets entirely. Why? Because they know the game. They know the West is playing a shell game with paper metal. They're not betting on ETFs, they're taking possession, and the more they take, the more stress it places on the ability of the COMEX and LBMA to deliver when real demand shows up. This is the heart of what we call backdoor arbitrage. the ability to turn a cash-settled paper derivative into real metal through delivery. It's the Achilles heel of the whole system, and it's being exposed by this wave of physical demand. The rising stair-step pattern we're seeing in gold is being built not by traders, but by central banks, sovereign wealth funds, and commercial buyers who are price insensitive. They don't care if gold is $3,200 or $3,600. They care that it's real. Even in the midst of the recent volatility, with gold being pushed down $100 in a day only to recover quickly, the volume of deliveries keeps rising. That tells you the disconnect between the screen price and the physical price is growing. At some point, that divergence snaps, and when it does, the paper market is toast. You'll see forced cash settlements, you'll see vaults refusing delivery, you'll see premium spreads explode. That's when the game ends for synthetic gold and begins for real gold. And here's where it gets strategic. Judy Shelton has discussed gold-backed treasuries. Treasury Secretary Scott Bent has openly said a new monetary system, perhaps a Bretton Woods III, could be introduced during this administration. Combine that with Trump's Easter tweet, "He who holds the gold makes the rules," and you start to see a narrative forming. One where the U.S. reasserts its financial dominance, not by issuing more debt, but by tying that debt to tangible wealth. Now, is that speculative? Sure. But ask yourself, what else explains the largest COMEX gold deliveries in history happening in back-to-back months? What else explains a treasury that used to ignore gold suddenly showing interest through public statements and staffing choices? What else explains the accumulation patterns we're seeing that make zero sense in a purely speculative environment? This is about power, monetary credibility, and national defense. And gold and silver are becoming strategic assets once again. They are transitioning from investments to monetary weapons. Not in the sense of war, but in the sense of leverage. Leverage against fiat inflation, leverage against foreign reserves, and leverage in global trade realignment. If you're watching this and you've been waiting for a good entry, you're looking at it. Because what we're seeing isn't a dip, it's a distortion. And the other side of that distortion is going to be a snapback so violent, it will leave most speculators chasing momentum they can no longer afford. If you want to be on the right side of that, you need to act before the market makes it obvious. This isn't about fear, it's about foresight. When the floor rises to $3,000 and the ceiling disappears, when silver reclaims its historical ratio and vaults to triple digits, when your paper wealth loses purchasing power with every bond auction, you'll want to be on the side of the trade that understood what was coming. Because remember, folks, he who holds the gold makes the rules. And those rules are changing.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.